What are the tax differences between an LLC and an S-corporation? According to the United States Small Business Administration, a growing portion of small businesses are structured as limited liability companies, LLCs, or S-corporations. Watch this video to find out which business type is right for you and to understand the structure of both business types, how they calculate and report tax liability, and how the owners of these companies pay taxes. Welcome back, folks, to another edition of Sweaty Kiwi. I hope you are doing fantastic today. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about a very important fiscal element, which is the distinction between an LLC, limited liability company, and an S-corporation. Now, LLCs, S-corporations, and pass-through taxes. Let's talk about this for a second. LLCs, classified for tax purposes as a sole proprietorship or a partnership, as well as S-corporations, are considered pass-through business entities. Now, the pass-through concept here means that the taxes of the business are reported on the business tax return, but they are passed through to the individual owners, right? So the owners ultimately receive a tax form that is included with the owner's tax return. So when the owner files their taxes, they have to include the business income. So that's the concept of the pass-through business entities. Now, LLCs and taxes. A limited liability company generally will have to register with the state, but the LLC isn't recognized by the IRS as a tax entity, right? So there was a debate a few years ago around the whole concept of LLC. So LLC is primarily a fiscally state-bound concept, if you will, because the IRS will not recognize them as tax entities. So LLC owners are therefore called members. Now, the IRS will treat LLCs either as corporations, partnerships, or as part of the LLC owner's tax return, which is fiscal analysts will call a disregarded entity. We'll have an entire show dedicated to that because it is a very interesting concept, the disregarded entity. It affects thousands of small business owners in the country, and we believe that this is a topic that deserves attention. So we're actually preparing a whole show around that concept. Now, how a limited liability company pays federal income tax will depend ultimately on how many owners it has. So an LLC with one owner, this is usually called a single member LLC. It's generally considered a separate, and again, disregarded entity, and it pays taxes in the same way as a sole proprietor. We did an entire show around the concept of sole proprietor, LLC, LLP, partnership, s-corp, and c-corp. You might want to double check that to understand the difference between a sole proprietor and an LLC. Now, so a single member LLC, for the purposes of taxes at the federal level, is treated the same way as a sole proprietor. Now, an LLC with multiple members is considered by default to be taxed as a partnership. Now, S-corporation and taxes. An S-corporation, sometimes you will hear people say subchapter S-corporation. That's the same thing. So S-corp and subchapter S-corp mean the same thing. Now, this is a special kind of corporation. We have an entire show dedicated to the characteristics fiscally and legally of an S-corp. So, but here, to sort of save time, I'm just going to go straight into the fiscal aspect here. So instead of the corporation paying federal income taxes, these taxes are passed through to the personal tax returns of the owners. In other words, the shareholders, right? So as you can see, for LLCs and S-corps, they are considered pass-through business entities if the owners ultimately pay the taxes. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweaty Kiwi. I hope you are doing fantastic and you are enjoying this content. If you love the clarity and quality of the content so far, please consider subscribing to our channel and turn on that notification bell so you can be informed whenever we drop a new show. and we drop shows every single day, rain or shine. I want to talk to you now about starting an LLC versus starting an S-corp. Now, if you're an entrepreneur, you're someone out there and you're just kind of wondering what really is important when it comes to the fiscal aspect of LLC and S-corp, because when it comes to deciding whether you should start your company as an LLC or S-corp, there are myriad factors. In this show, we're only focusing on the fiscal aspect of things. Now, an LLC is formed when it registers with the state, right? And it does so by filing something called the Articles of Organization. An S-corp, on the contrary, does not do that. An S-corporation does not register with the state. First, the business must register with the state by filing something called Articles of Incorporation. Then, the corporation may elect S-corporation status by filing something called Form 2553 with the IRS. Now, this is a form that is specifically for Subchapter S corporation, and by filing that form, the business is electing to be treated as an S corporation. An LLC may elect to be taxed as a corporation or as an S corporation. Now, to do this, the business must file an election on Form 8832 by a specific date. One thing you want to make sure is that it is very important. Every business has its own business model or its own objective. So if you're interested in transforming or converting your business legal structure from an LLC or LLP into an S-corp, you might want to check with a tax professional to discuss the pros and cons of this election. You can contact a local CPA, a certified public accountant, or an EA, an enrolled agent, who can help you sort of get into the nitty-gritty of the election process. Now, the form for electing S corporation status for an LLC is really different from the form of electing S corporation status for a corporation, right? So basically what I'm trying to say here is that there are two forms. So you have Form 2553. That's the form where you elect with the IRS, you elect S corporation status, 2553. And then you have Form 8832. That's the form where you, as an LLC, you want to be taxed as a corporation or as an S corporation. And again, this form must be filed by a specific date. Now, let's talk about reporting federal income taxes. Now, single member LLC members generally will pay income taxes on the net income of their business through their personal tax return, right? So what I'm trying to say here is that if you're a single member LLC, in other words, you are treated for tax purposes as a sole proprietor, you are doing your P&L, the profit and loss for the business, and you transfer the data onto your tax return, onto your 1040. So if you are, say for instance, you are in the 30% category, or the 25% category rather, and you made $100,000 in net income for the year, you transfer then that $100,000 onto your tax, onto your 1040, and then you have to pay $25,000 if you're in the 25% tax bracket on that. So that's for a single member LLC. Now, multiple member LLCs report total partnership taxes on IRS Form 1065, U.S. Return of Partnership Income. That is if and only if they have filed, remember what I said, they have filed Form 8832 to be taxed as a corporation or an S corporation. All right. So multiple member LLC report total partnership taxes on IRS 1065. Now, this form is an informational return because the partnership doesn't pay tax on its income. The income is passed through to the individual partner LLC member tax returns, right? Again, going back to the whole concept of pass-through entity, pass-through fiscal process. S corporations will report federal income taxes on IRS Form 1120, 1120S. It is the same form that C corporations also use. The only difference is that they have the suffix C. So C corporation will use Form 1120 1120-C, but S corporations will use 1120-S. And the form is called the U.S. income tax return for a C corporation or an S corporation. Now, the taxes are paid by the shareholders based on their share of the S corporation taxable income. It is the same, if you think about it, it is the same process, if you will, in terms of the pro rata of the income. So if you have for example, you have 4 members or 4 partners or 4 shareholders who share equally in the profit, each person will have to take home 25%. So they're paying taxes at the personal level on the 25% income they earn from the partnership or the S corporation. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. If you have questions or you have experience, you own a single member LLC, or you're part of a multiple member LLC or s-corp, please comment below. Let us know your experience with the whole process. Share this comment and like. Now, what are the differences between S corporations and LLCs when it comes to taxes? Number 1, owner tax report forms. So single member LLC members report business income on Schedule C of the tax return. So a single member LLC member, which in other words, the person is treated as a sole proprietor for tax purposes, for federal tax purposes, that person, that owner, will report business income on Schedule C of their tax return. If you remember earlier, I was taking the example of somebody who earned 100 grand from the business, and that person will have to report that 11,000 on Schedule C on their tax return. Multiple member LLC members report their share of business income on a Schedule K1, and that's for Form 1065. Not 1120, 1065. 1065 is for partnerships, so the schedule is K1. Now, S corporation shareholders, on the other hand, will report their share of business income on Schedule K1, but this time on Form 1120-S for shareholders. Remember that you have information from the Schedule K1 for each multiple member LLC member, and S corporation shareholders is included in something called Schedule E, Part 2 of the owner's tax return. In other words, the IRS goes through that Schedule E to reconcile the data that all members, all LLC members, and S corporation shareholders are providing the agency. That way, they can see if there is fraud or if there is inconsistencies or inaccuracies. So that Schedule E, Part 2, is a central tool for reconciliation at the federal level. So now let's talk about self-employment taxes. LLC members are considered to be self-employed. Therefore, they must pay self-employment tax. I'm talking here about Medicare tax, Social Security, and they must pay this on their share of the profit of the business. S corporation shareholder income is not self-employment income, and therefore is not subject to self-employment tax. This is an important distinction. So if you want to elect S corporation for your company or LLC, you want to think about the self-employment taxes. Total income for LLC members may include different kinds of income. I'm talking here about dividends, capital gains. Now, those kinds of income are not considered self-employment income. Schedule K1 for this owners has a separate category for self-employment earnings or loss. Let's talk now a little bit about the QBI, the Qualified Business Income Deduction. LLC members, as well as s-corp shareholders, may be eligible for, it really depends, but in general, they may be eligible for something called QBI, so the Qualified Business Income Deduction, for tax years beginning in 2018. Now, this is if you qualify, I would strongly encourage you to deduct that, because the deduction is up to 20% of the qualified business income, 1/5, in addition to standard business deduction. So you have your standard business deduction, and then you add on to that the qualified business income deduction, which could actually go all the way to 20%. That's huge. Let's talk now about limitations on business losses. Business owners who don't materially participate in their businesses may not be able to claim all losses on their tax returns. Let me repeat that. Business owners who don't materially participate in their businesses may not be able to claim all losses on their tax returns. There are two things to remember here. The word materially in accounting jargon means significantly. So if you're a business owner and you don't significantly participate in your business, you may not be able to claim all losses on your tax return. So there are two things I want you to remember here: materially and all losses. In other words, you might be able to claim some losses, but not all. So even if you don't materially, meaning significantly, substantially participate in your business operations, you may be able to claim some losses, but not all. So for you, if you really want to claim all losses on your tax return, you need to participate. You need to participate significantly in the business. Now, the IRS hasn't really set standards for what determines materiality here when it comes to running the business, but experts believe that if you're spending 3/4 of your time, 75% of your time on business matters, chances are you do pass the threshold for materiality when it comes to business participation. And in contrast, someone who is a silent partner, if you are a silent partner, in other words, you just put your money in the business and you just disappear and you don't participate actively in the day-to-day operations of the business, you can't really claim all losses on your tax returns. Owners of LLCs and s-corporations are both subject to passive loss limitation rules, right? Those rules change as tax laws every year, so right now we can't really go into details here, but just suffice it to say that the information contained here is only for general purposes to help you understand the basics. We're not giving tax or legal advice. Everybody understand that. We are an infotainment show. We provide general information. We do research and we provide information. If you want to have more information about your personal business or your personal organization, please consult with your CPA or attorney or EA enrolled agent to discuss your specific business questions. All right, folks. So this is it for today. I really appreciate having you around with the conversation. And let me quickly recap that we talked about LLCs, s-corporations, and pass-through taxes. We talked about the LLC and taxes. We did the same for s-corporation and taxes. And I really sort of had a conversation with you around starting an LLC versus starting an s-corporation, how to report federal income taxes, and the differences between s-corporations and LLCs. I will see you next time. But until then, remember, stay marvelous.